Hello, everyone. Welcome back to another edition of the Week in Charts. I'm your host, Charlie Bilello, and as always, I'm going to bring you the most important charts and themes that I'm seeing today. If you're watching this on YouTube, take a moment, hit that subscribe button for more content just like it. Before we begin, I want to talk about this exciting offer from my firm, Creative Planning. They're offering a free wealth path analysis to all Week in Charts viewers. What do you get with that wealth path analysis? Well, if you sign up for a call with an advisor or a meeting with an advisor, you'll get a portfolio checkup, looking at your portfolio, making sure it's diversified, making sure it will meet your goals and needs, retirement roadmap. Are you on the right path to retirement, to financial independence? Proactive tax strategies. Are you taking advantage of things like tax loss harvesting, asset location, optimal charitable giving, and more? An insurance estate planning review. Do you have all of your estate planning documents in order? So we're going to take a look at all of that for you. Sign up for a free wealth path analysis. Why do you need to invest? Well, I think this one chart really illustrates this. Over time, your purchasing power is being eroded due to inflation. In the past 30 years, over 50% decline in your purchasing power. And as an investor in U.S. equities, you would have outpaced inflation by 962%, which is about 8% per year. So reach out today to us at Creative Planning. We have over $300 billion in assets under management and advisement. We're in all 50 states, so we likely have a location right near you, and we're here to help. creativeplanning.com/Charlie. Schedule a call or a meeting today. What are we going to be discussing on today's episode? A lot of important topics. Number one, the market has really moved from panic to euphoria in record time. About 3 weeks ago, everybody was panicking. It's going to be a recession, a carry trade, all the rest of it. And now we're almost back at new all-time highs, a period of euphoria once again. Number two, front-running the Fed. I want to talk about some moves in the bond market and interest rates. Number three, I'm asking this question here, is the unwinding of the carry trade already over? I'm going to show you some data that may suggest that it is already over. For the Fed's revisionist history, big meeting this week at Jackson Hole. I want to talk about some comments from Jerome Powell. We'll talk about, obviously, what's going to happen with the Federal Reserve's interest rates at the September meeting. Number five, the dollar's been going down, gold going up. We'll discuss that. A tale of two housing markets, very interesting divide we're seeing between existing homes and new homes in terms of sales, in terms of pricing. Interesting data points that I think you'll find pretty revealing about what's going on in the housing market. Number seven, I'll give you an earnings update. The latest, we almost have 90% of companies reported. NVIDIA is coming next week. Obviously, that's the big one people are focused on, but I'll give you the latest in terms of earnings. The inexorable rise of e-commerce is a huge secular trend I want to talk about, and we'll end, as we always do, with something positive, and that would be lower gas prices. Okay, let's begin with the financial markets, equity markets, from panic to euphoria. You could see it in the chart here of the S&P 500. Wasn't an enormous sell-off, but it was a huge period of panic for the markets. Of course, we talked about the VIX going above 60 briefly on August 5th. It was a little under a 10% decline for the S&P 500. You can see here almost a V-shaped recovery here. We're almost back at new all-time highs. It's rallied now over 10% off of the lows on August 5th. And if we look at some of the big names, the enormous eight here, led by NVIDIA off of the August 5th lows, we're talking about a 43% gain. NVIDIA almost back at new highs again. Bitcoin's rallied 29%, the Nikkei 23%, Tesla 21%. If we look at the major indices here, NASDAQ 100 up 13%. Small caps had a big day today on Friday, up 12% now off of the lows. S&P 500 10%, as we talked about. And we have Microsoft and Google rounding out the enormous 8% and 7% gains. If we look at NVIDIA, 161% gain now year to date. That was the biggest correction we saw all year, but it's quickly rallied back. And so it's going to head into earnings next week with expectations, again, very high. I think it's going to be telling what NVIDIA does. We know the report's going to be very good. The question is, how are investors going to react to that? But I'd say expectations very high heading into that earnings report. So if we look at the areas that are very sensitive to interest rates, and we saw this before that correction, before that 10% sell-off, we saw rallies, big rallies in small caps and home builders and regional banks. And what we saw on Friday after Jerome Powell's comments, which pretty much solidified the September rate cut, I would say, is another big rally in all of these areas. You had small caps up over 3% on the day, home builders up over 4%, and regional banks up over 5%. So interesting to see that trend kind of resuming. It was kind of put on hold there with that correction, and now kind of resuming that optimism, I would say, over the coming rate cuts. And if we look at the S&P 500 year to date, now I'm showing this table again because once again, it's one of the best starts to a year ever through 163 trading days. Here you have the S&P 500 index up over 18% year to date. And this is now the second best start to a year for a presidential election year ever. Only 1936 presidential election year was higher at this point in time. So once again, one of the strongest returns we've seen in a long time to start a year. Still obviously have a few months more to go in the year, and anything can happen in those few months. But here and now, one of the best starts we're seeing in history for the S&P 500. Number two here, front running the Fed, and clearly the bond market is now pricing in a series of rate cuts to come. And why do I say that? Well, if you look at all different yields here, all different yields across the yield curve, 1-year Treasury rate to 10-year Treasury, you can see they're starting to price in those interest rate cuts and do so in a hurry. You can see really started to accelerate lower starting in June, and you can see the trend here has continued. And we're looking now at a 10-year Treasury yield of around 380. We entered the year at 388, so down now on the year. And if we look at the relationship between bond prices and yields, you can see that inverse relationship. So bonds peaked on a total return basis back in the summer of 2020. So now it's been 4 years this bear market's going on in the bond market. And that's by far the longest bear market in history for the bond market. You never had a period where it was in a drawdown for this long. But now you're starting to see that recovery here. And you're seeing that because interest rates are declining and investors are earning a higher coupon on their bonds as well. And if we look at the past year, this is very interesting because a lot of people were saying a year ago, you just want to stay in cash. Cash is the place to be because of that huge bear market in bonds. But as we talked about, when you have interest rate cuts, bonds tend to do very well. And now they're starting to anticipate that and price that in. And lo and behold, here we have the aggregate bond ETF up 9.6% over the past year, outpacing cash. I'm looking at the Treasury bill ETF up 5.4%. So widely now outpacing that because interest rates are down over the last year. And again, I come back to this chart here, looking at Fed rate cutting cycles. We don't know how many cuts they're going to do, how low they're going to go, but history has shown that bonds have done pretty well historically, definitely above average returns during most of these Fed rate cutting cycles. So it seems like pretty much a done deal, as I'll talk about in a little bit, that the Fed is going to cut rates in September, and bonds are obviously getting ahead of that and starting to price that in. So number three here, this was the big story a few weeks ago, August 5th. You had that panic over the unwinding of the carry trade. We had the Nikkei crashing, and you had just record speculative net short positioning in the Japanese yen. And look how far we've come in just a short period of time. You're looking at speculative positioning, according to the CFTC, going from a record net short 184,000 contracts to the end of last week actually being net long the yen. So this is one way to kind of measure the carry trade, and perhaps already it has been unwound if we're just looking at this data point here, the fact that speculators went from being record net short to net long here. And if we look at the Nikkei, I want to come back to this chart I showed you a few weeks ago, looking at these crashes in the Nikkei historically and what it did 1 year forward. And what we said was oftentimes crashes have provided an opportunity for investors looking at a year ahead. The three biggest crashes in history were in 1987 for the Nikkei, 2008, and 2011, and a year later, strong returns each and every one of those periods of time. And that seems to be, it's only been a few weeks, but that seems to be on pace to be the same here. If we're looking ahead a year from now, who knows what could happen, but so far up already 23% off of the lows from August 5th in terms of the Nikkei. You can see back to having a pretty good year, up 15% year to date. So a lot can change in a short period of time, and following periods of panic, you tend to have these snapback rallies. But I would say this rally back has been stronger than anyone would have expected, looking at not just the Nikkei, but looking at the biggest growth stocks, looking at the S&P 500, looking at the NASDAQ 100. Everything has snapped back much quicker than I think anyone anticipated. And it's because I think the recession fears have really pulled back to a large extent. All right, I want to talk about the Fed's revisionist history here. Jerome Powell had some interesting comments at Jackson Hole this week. He said the rise in inflation is a result of rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices, which is interesting. You might note that he's leaving out a few of what I would say are the elephants in the room here in talking about the money supply and national debt. No mention of that still from Jerome Powell at any meeting, and he still is holding on to the idea that inflation is just a result of increased demand for goods. Well, how did the demand for goods suddenly increase? Did it have anything to do with the huge expansion in debt and stimulus payments? Did the tight labor markets have anything to do with that as well? And so really no mention of the reality here. And he's saying at the end here, Powell is saying there's still much to be learned from the experience, that this is his assessment of the events. Your mileage may differ and differ. My mileage definitely differs because it's based on reality. If it was just the supply chains, that seems to be the biggest thing that they've been talking about in terms of causing inflation. If it was just the supply chains that resulted in higher prices, well, as soon as the supply chains normalized, those prices would have came back down. And of course, that didn't happen. All we've seen is the rate of inflation come back down, but if prices have not come back down. So this is a global supply chain pressure index. You could see extremely stretched here, difficulties in terms of the supply chain. We've talked about that, heard all that about that, but what you didn't hear is that it largely normalized, and it's been normalized for over a year and a half now. And there's really no mention of, okay, why hasn't that led to lower prices? And the reason for that it hasn't led to lower prices is because we haven't seen the money supply and national debt come down, right? So we saw a normalization in terms of the rate of increase in terms of the money supply, but there's no anticipation that the money supply is actually going to contract and the US national debt continues to go up. So in terms of the primary causes for inflation, it's everywhere and always a monetary phenomenon. We had the biggest money supply increase in history, and yet the Federal Reserve, there's no mention of that whatsoever in terms of saying what was the cause of inflation. So have they learned something? I don't think so, because they're not acknowledging it. They're certainly not acknowledging the fact that we ran these enormous fiscal deficits. We borrowed trillions of dollars in a short period of time, and we sent that out. And of course, when you have too much money chasing too few goods, you're going to have higher prices as a result. So this is kind of revisionist history where the Fed isn't taking any of the blame for the rise in inflation whatsoever. They're saying it's all these external forces that were outside of their control, when we all know the truth that they had a big hand, obviously, in the money supply. And they were cheerleading, if you read their comments from 2020 and 2021, they were cheerleading doing more fiscal stimulus and borrowing more money. Now the Fed is saying they're independent and they're not getting involved with fiscal issues. But back then, they very much endorsed the idea that you could borrow a massive amount of money and it wouldn't lead to higher prices. And in terms of what his statements were saying about the what the Fed is going to do in September, I think it's pretty clear before this meeting that the Fed wants to cut interest rates in September, and he's explicitly saying the time has come to adjust policy, but he's leaving room for different timing and the pace of cuts. It depends on the incoming data, but we know there's enough data at this point for the Fed to do what it wants to do, which was start cutting interest rates. And I think if there was an additional data point this week that we got that really would have solidified the cuts, it would be the fact that we got this huge revision in terms of the number of jobs that were created over the last year was actually revised lower by 818,000, not a small number. You tend to have revisions, but not that big. And so over the past year, you're looking at 174,000 jobs that were created per month versus 242,000 previously. So additional data points saying the U.S. labor market wasn't as strong as the numbers were suggesting, which would suggest that the Fed should be more concerned about their maximum employment mandate, which I think is just additional evidence that they would need to say, okay, let's err on the side of cutting interest rates. So what are the markets saying? The markets are saying 25 basis points is 100% priced in at this point, and they're leaning more towards that 25 basis point cut than 50 basis point. But there's still a chance of 50 basis points. I think there's going to be obviously two big reports that dictate whether the Fed do 25 or 50. One will be the employment report that will come out in early September, and the other will be the next CPI report. And if the employment report is extremely weak, maybe they do 50. But if it's not, I really think that they want to at least start out with a slow move down and a 25 basis point move down. We saw all of the other major central banks start out with 25 basis points. So the idea that the Fed is going to start with 50 basis points outside of a recession, outside of a financial crisis, I think that's a little bit of wishful thinking, but we'll see. If, let's say, you get another big spike higher in the unemployment rate, maybe they would consider doing 50, but I don't think it's very likely. I think at this point, 25 basis points is the way to go. But heading into that meeting, the Fed will do whatever the market's expecting it to do. So we'll look at this a few days before. If it's leaning towards 25 basis points, that's what they're going to do. If it's leaning towards 50, I think that's what they'll actually do. So focus on this as it gets closer. And then from there, it remains to be seen. It seems like the market's saying the Fed's going to cut November, December, but a lot can change between now and then. Obviously, if inflation starts moving in the other direction, employment starts to firm up again, a lot of different things could change that outlook. So really, these probabilities and odds are only good for the very short term. But I think that September meeting, for them not to cut at this point, I think would be a huge change. I don't think that's going to happen. I think we're going to get the cut. It's just a matter of 25 or 50. And my bet is that they'll start with 25 basis points, especially with the way the market's recovered here. We're almost back at all-time highs with the S&P 500. Fears of a recession are down. There seems to be no reason to start with 50 basis points. Okay, let's talk about the dollar and gold here. Dollar, interesting. We know that it had been strong for a period of time here, but we're seeing a weakening as these expectations of interest rate cuts increase. The dollar is going down. So a more dovish policy from the Fed. So kind of aligning more with these other developed central banks that have already cut interest rates, like the Bank of Canada, like the ECB. And so we're seeing weakness now in the dollar, lowest levels since last year in terms of dollar. So it's now down on the year a little bit. And if we look at gold, opposite here, looking at gold at an all-time high, up 22% year to date. And gold, I always say, is an enigma. A lot of people are questioning, well, why wasn't gold stronger over the past few years, given the concerns about national debt, given the concerns about inflation. The biggest driver in terms of short-term relationships for gold seems to be real interest rates. I've tested just about everything in terms of gold. And gold, the biggest in terms of inverse correlations, even more so than the dollar, would be real interest rates. And when real interest rates are falling, that's good news for gold. When real interest rates are rising very rapidly, like we saw in 2022, that tends to be bad news for gold. So real interest rates, so inflation adjusted interest rates, are moving lower again. So looking at the real 10-year a treasury yield now at 1.68%. So moving down pretty much at its lowest levels of the year. And I think that's an additional factor helping gold here. So gold doesn't like competition from risk-free treasury bonds. And if you're looking for a reason why gold has been strong of late, I think this is one of the biggest reasons that you're getting paid less above the rate of inflation in terms of if you're buying a 10-year treasury bond. And so I guess the expectation would be if you think the Fed is going to continue to cut interest rates over the next year, you're going to see real interest rates, particularly on short-term bonds. If we're looking at 1-year treasuries or 6 months or 3-month treasuries are going to be lower in terms of their rate above inflation. And so that perhaps will be additional good news for gold if that were to play out that way. So gold, very much an enigma. Past year has been very good. I think one of the big reasons for that, obviously, is lower real interest rates and the expectation that the Fed is going to go back to a more easy monetary policy. Okay, I want to talk about the housing market here. It's been the best of times or the worst of times in terms of the housing market, depending on whether you're looking at existing home sales or new home sales. I'd say the existing home sales market has been just about as bad as you can get here. Looking at the rate of homes being sold over the last year, 3.95 million. You can see here, going back in time, we're pretty much at the lows here. You got to go back to lows from the financial crisis, even lower than the COVID lows in terms of the number of existing homes that were sold over the last year. It's down 2% year over year, and this is now the 35th consecutive month showing a year over year decline. That's the longest down stretch in activity since 2006 to 2009. So you can see this long period of negative year over year activity in existing home sales back during the financial crisis. And you're seeing that again today. The big difference, of course, today, as we've talked about, is home prices are not falling like they did back then. They're still continuing to rise, albeit in the last few months at a slower pace. Now, this is the tale of two cities chart that I'm illustrating here. The big difference between the new home sales market and existing home sale market is inventory, is supply. And if we look at U.S. new homes for sale, you can see here it's been trending up, and it's at the highest point that we've seen since 2008. Look at existing home sales. We're coming off record lows. It's just starting to trend a little bit higher here, but still well below the historical average. And that's why you're seeing almost no activity in the existing home sale market, why you're seeing prices remain elevated. It's really because supply still remains constrained. And what we talked about last month was this weird situation where you actually had the median price of a new home sold was lower than the median price of an existing home sold. And that's a weird thing, of course, because you would think that new homes should sell at a premium to existing homes for a number of reasons, but that wasn't the case last month. A weird situation, not likely to persist, but what we were saying is on a relative basis, people were getting more value for these new homes relative to existing homes, and that was simply because of this supply and demand dynamic where more new homes are available for sale, and that's leading home builders to want to cut prices, incentivize sales, and that's offering a better relative deal for buyers. And what we're seeing, and this is just one data point, but what we're seeing is the new home sales increase 6% year over year, while existing home sales are still down. So big difference in terms of activity, and simply as a percentage of the market, really we haven't seen this before, where new homes are making up the highest share of a market. Over a third of the market is new homes because you just have this low existing home inventory for sale. So I think this is going to continue to trend higher, but for now, the new homes in terms of sales are on the upswing, and that's been good news for home builders who are already doing very well. But you can see here, this is a huge secular, I think, trend here. We've talked about there being a deficit in terms of homes being available, and there was a huge contraction in terms of the industry after the financial crisis, a lot of home builders went out of business, smaller on the smaller end of the market, and these bigger publicly traded home builders that are still around, well, they've been able to increase their profits significantly over the last 10 years. Obviously, huge demand for more new homes in the US. You can see just stunning gains in the five biggest US home builders: DR Horton, Pulte Group, MVR, Lennar, and Toll Brothers. You can see enormous gains across the board. We're looking at DR Horton up 881%, Pulte 711%, just crazy gains. And you can see it's been backed up by gains in their net income. So 834% increase in profits for DR Horton. And we're looking at Pulte up 491%, Lennar up 643%. So just been incredible businesses. And if you think that there's a few years of more homes to be built, in terms of we need so much more supply, and it's going to take 3 years, 5 years, 10 years to catch up with the deficit of homes in the US, then this is a trend perhaps that can continue into the future. We know we need more homes, especially if existing homes supply remains very low. You just have increasing demand for new homes. And if we look at good news in terms of supply for existing homes, I'm pointing to this chart, but it continues here. This is about the point of the year where you tend to see number of listings go down. So we should expect that to trend lower as we go into the fall and the winter. But the good news is we're seeing an 18% increase in terms of the active listings of homes for sale over the past year. And you can see highest number of listings, a little bit over 1 million listings in the US right now of homes for sale. That's the highest we've seen since 2020. So that's the good news in terms of supply. The bad news is it's still pretty low, and that's leading to, of course, prices continuing to rise on a year-over-year basis, although I would say that it's slowing here, up 3.6% year over year. My expectation would be, as supply continues to increase in the coming months, coming years, you're going to see this rate of increase in terms of home prices continue to decelerate because of that affordability picture that we've been talking about. So demand still very much constrained because of the lack of affordability, and all you need is to see more supply coming onto the market to see prices start to normalize and become more affordable. And that's been happening in the rental market, as we've been talking about, but it hasn't happened in the housing market, houses for sale, because of that supply constraint. So it'll be interesting to see in the next year, if we have lower interest rates, what that's going to do in terms of the dynamics. Is it going to lead more people to move and supply to increase, and home prices to actually come down, which would be the opposite of what we saw over the past 2 years. Number 7, Q2 earnings update. Almost 90% of companies now have reported in the second quarter. You have S&P 500 profits up 7% year over year. So another positive year over year growth story here for the S&P 500. I would say kind of coming in a little bit better overall than expectations heading into the quarter. But of course, as we talked about, the price increases in the S&P 500 and a lot of the big stocks have way outpaced the earnings growth. So this has still been a multiple expansion story if we're looking at the US equity market. If we look at sales per share here, you can see 5.8% increase year over year, still very strong, still running above the rate of inflation. So for now, companies, if we're looking at Q2, still very profitable. I think the NVIDIA report is going to be extremely important, obviously, because of all the spending that's going into AI, and that'll be the big gauge there in terms of, is there any slowdown showing up in NVIDIA's results, and is there any give in terms of its margins, which we've seen just increasing profit margins quarter after quarter for NVIDIA. So we'll definitely talk about that next week in the next week in charts. Number 8 here, I want to talk about the inexorable rise of e-commerce. And things are always changing in markets, hard to predict the future, but this is probably one area where you can say 10 years from now, there's going to be more e-commerce than there is today. And the reason for that is my first principle here, saying if something can be done better, faster, and cheaper, it will eventually be done better, faster, and cheaper. I think that's the story of e-commerce, and it's only going to get better, it's only going to get faster, and it's only going to get cheaper because of it. And if we're looking at e-commerce as a percentage of total retail sales, this number is still shockingly low to me, but in 1999, it was 0.6% of total sales. 2009, 4%, 2019, 10%, and here we are today at 16%. So I don't know where we're going to be 10 years from now. I just know this number is likely to be much, much higher. And that will probably be a good thing for the US consumer, because it means you're probably going to be getting the goods that you need faster, cheaper, and hopefully better as well in terms of just having more variety to choose from. So this is a story for every company, whether you're in retail or you're in any space. It's increasingly becoming obviously an e-commerce world, and this is a secular trend that I don't think is going to change in the near future. So I want to end, as I always do, with something positive, and that would be lower gas prices. Here is a chart showing you the national average gas price in the US, $3.38 a gallon. That's now 47 cents lower than a year ago. And what that means for the CPI report for August, I think it's going to mean a big drop. I think it's going to be one of the big contributors there. And what the Cleveland Fed is expecting is 2.6%. That would be down from 2.9%. And if we look at inflation adjusted gas prices over time, it's important to adjust for inflation. You can't just look at the nominal price, of course, because there's been inflation, right? People's wages are higher, the input costs are higher. So you're going to have, all else equal, higher prices. But the good news for the US consumer is we haven't seen an increase over the last 40 years when you adjust for inflation. It's actually lower today than the early 1980s when we had that last inflation spike. So certainly very difficult time in 2022. We saw this spike here again on an inflation adjusted basis, but we've since come down. Hopefully it'll stay down. Hopefully it'll go lower. What's good for the US consumer, of course, is for energy prices, not just gas prices, but electricity, everything to come down over time, and less of your income going towards energy, and then you have more money to go elsewhere. So I think that's been one of the hallmarks of prosperity for the human race over time, is that we're spending less of our time working to pay for daily energy costs. And so if we can get this chart to go lower over the next few decades, I think that's going to be great news for everyone. And with increase in technology and production and efficiencies that we're finding, I don't see any reason why this shouldn't get better in the years to come. Obviously, it's not just a gas story anymore with increase in electric vehicles. It's going to be the cost of electricity as well that we're going to start to monitor. And so hopefully, again, this chart goes lower. But the good news is that where we were in 2022 was a very bad place, and we're in a much better place today. Okay, I want to end it right there. Thanks everyone for watching the Week in Charts. Have a great weekend. If you're watching this on YouTube, hit that subscribe button for more content just like it, and I'll see you next time on the Week in Charts.